Welcome to TMS Insights. It's the end of financial year. It's been a good one for the markets, but it ended today, only 10 minutes ago, a bit softer. And it's Ben Clark and Jeremy Hook bringing you the update for the year that's just been, and a little bit of an insight into what's coming up ahead, Ben. So ultimately, it was a good year for the market, but it was really, in many patches, not easy.
No, it was one of the most bizarre years I can remember in the market, where really what has driven our equity market, and today as well, has been what's happening in the bond market. And in the first half of the year, we saw a massive spike in bond yields right around the world, which led to banks running, resources running, value stocks running, and high growth infrastructure and property trusts all getting sold off. And the second half of the year, we saw bond yields retrace or fall around the world as everyone realised Trump wasn't going to stimulate the US economy as fast as we thought, and the mirror image happened where we saw everything reverse. But we're starting to see bond yields kick up again, and that's, it looks like that process might have a bit more to go.
And this goes back to just now over the last couple of weeks, what emerged with the Federal Reserve's first move in a little while, and surprisingly probably Europe and the central bank there, and almost globally amongst Western nations, some idea that the risks in not raising rates are growing, and they need to move a little faster than first thought.
Yeah, I mean, I think the big shock was actually the Bank of Canada coming out and saying that they are looking at lifting rates in the second half of this year, which was a major surprise. So it almost feels like the banks are coordinating this activity to soften investors up and prepare everyone for the path that they want to take, which is probably the smart path to take. Yeah. But when it's not expected, you get these sudden jolts in markets as they try and price it in.
Big moves, and we saw that certainly over this week. And so the Aussie dollar's had a good run up, with commodities being a bit stronger, bulks and some of the base metals as well there, Ben. But this is an interesting one for the policymakers here, as we know that the budget's obviously had its own impacts, some interesting changes there, and the RBA not really sure where to go at the moment.
Yeah, well, I'm actually surprised the Aussie dollar's been so strong, because I think interest rates in other countries are probably going to go up a lot faster than they are locally. I don't think our economy probably has the strength to handle higher interest rates at the moment. And it's an interesting one, Jeremy, because I think we might see a bit of weakness in the Aussie from here, and that'll give those offshore earners a bit of a bump, hopefully. Yeah. But they have actually been going up despite the stronger currency.
Interesting. So 10-year bonds are around 2.6 at the moment. It seems to be moving up, which is in many ways bad for parts of the equity market. So to explore those ones this week, we saw a lot of ex-div stocks in the red and infrastructure space. They were actually the worst performers, apart from the dividend, because of that bond yield story.
Yep, definitely. So they're the most susceptible. Of course, why they're susceptible is they generally carry a reasonable amount of debt, which is funded over bond yields. So debt's got a bit expensive for them to finance. You can't pass that straight through to your tenants or your passengers going through your airport. But secondly, the share prices are generally priced against what's going on in the bond market. So if bond yields go up, investors need to get a better yield out of those sort of businesses, and therefore the share prices have to come back. So, your Westfields, GPTs, Stocklands, and then your SIDS, Transurban's, etc. They're very bond sensitive in the pricing. But there has been quite good distributions paid out during the week, which has made it look a bit worse than it really is. Yeah.
And talking distributions and looking ahead now, next week, the first week of the financial year, does see a lot of those bank stocks pay their dividends. So billions of dollars do come back to local shareholders, and some of that will be deployed back into the market.
Yeah, I think July historically is one of the strongest months of our calendar year in market performance, and that's one of the reasons put behind it. I think also you do tend to see that bit of tax loss selling into the end of June, which means that maybe some stocks get a bit low than where they should be. It's not meant to happen, but it does. Subsequently, we might see a kick higher, I suspect, in the next few weeks.
And I think too, from a lot of the big institutional investors kicking off with new funds in the new financial year, they wait till that July rolls around and get going with that. So that's something that we'll see, and some repositioning in the market, probably a few more changes, but July to be expected to be a good start to the financial year. Challenges ahead though, perhaps. We've got August reporting season. Had a few companies downgrade over the last little while.
Yep.
Something we'll be watching very closely as July ends, because we do see sometimes profit warnings or even some expectation increases in that period.
Yeah. Look, nothing to worry about really so far, but it is that so-called confession session we're coming into again. And look, hasn't been too many yet, and I still get the feeling that the economy's kind of going okay, and hopefully most businesses will hit their numbers. The market still has a reasonably high level of earnings growth priced in for the forward year, and we have seen that this has been a trend in Australia for a number of years now, where the market expects next year earnings are going to start to go, and it gets pushed out another year and another year and another year, and it's really been because the banks and resources in particular dominate our market. But the resources seem to be coming good at the moment.
Improving, yes.
Yep. And I think banks from here, banks are one area of the stock market that will do very well if bond yields do rise. Because
margin improvement. And
exactly. Yep.
So there are a few areas and themes that we will be working on as July and August roll around. We'll bring you our next update in later July. But for now, happy end of financial year. Good luck for the next one. Thanks, Ben. We'll see you all next time.